So welcome back to Inside Private Credit. Today we're talking about LVR, which is a term that a lot of advisors are probably used to looking at now in private credit, and fund managers are getting used to talking about LVR. But what's misunderstood, I think, for advisors is what the V in the LVR is, and the importance of the V in the LVR when advisors are looking at private credit funds. So today I'm joined by Matt Samuels, who's Head of Investments for Woodbridge. Welcome, Matt.
Thanks, AT. Good to be here.
So Matt's on the deal side of the business. Matt looks after all the investment side and is our internal expert, if you like, on valuations. So, Matt, listen, a good place to start is, for advisors when they hear LVR, what should advisors be thinking about?
Yeah, so at a really simple level, LVR stands for loan to value ratio. So, in terms of simple maths, so, if you have a loan amount of 20 million and an valuation amount of 40 mil, simply your LVR is 50%. And typically the lower the LVR, the lower the risk. So the valuation has to fall by more for a lender to lose $1.
When advisors review a funds, obviously they're used to saying, well, what's the LVR of the private credit fund, and the investment manager will say, well, our average LVR is 60%, and but that's not really the point, is it? The point is that what's the basis of the V? Is that how's the V being calculated for advisors, and how's the V being determined? And obviously, if the V is wrong in the LVR, then as you say, 60% might appear low, but 60% might not be so low.
Yeah, exactly. So it's a hard space for advisors to if they can't see the valuation. So for example, if you look at it at a loan level, right, like you can have one lender can have a loan of 20 mil, and it can be an office building, and they could have a valuation of 30 mil, and then another lender might have a loan of 20 mil, and then their valuation methodology might result in a valuation of 40 mil. So the LVRs are different, but there might be a similar office building, but it results in a different LVR, and it's a different, it shows a different risk level. So it may be hiding risk in a fund, but so it's very important to analyse the V and the LVR, and that's what really is quite important, and it's a key consideration for advisors.
Yep. So let's talk about, I guess, the three valuation types that private credit funds Australia are using. You've got valuations done internally by the investment manager. You've got funds using external valuations that are done external to the fund manager, and then you've got funds using a hybrid method where they've got external valuations and perhaps they're overriding them or using part. So it's probably worth, Matt, just giving a deep dive, I guess, on those three types, because it's the devil's in the detail, isn't it, with this stuff?
Yeah, exactly. And each one is very different and have different aspects to it. So I guess firstly touching on internal valuations. So that is where a lender would pick the valuation figure internally themselves. They may have a property expert internally. They may be relying on a sales agent advice, or they may have done their own internal discounted cash flow. So again, it's not a true transparent look through an internal valuation. It is subjective, and it may not show the true risk in the fund, and it does create a bit of a conflict of interest as well.
Yeah, and listen, and I don't think you're probably suggesting that all internal valuations are bad, but there's a massive conflict of interest issue on a fund that's valuing their own assets, and obviously it's like valuing your own homework. Is that the fund can take an over positive view on the value of the asset, which can lower the V, obviously. So, I think for advisors, fully internal valued funds are hard, aren't they? There.
Yeah, the incentive is never to, show a lower value or a higher LVR. You would be trying to show the lowest LVR and the lowest risk. So it's hard for advisors, right, to understand, are they getting paid for the risk at 65 LVR, or are they really at 70, 75 LVR, and then they get paid for that risk. And then secondly is throughout a life of a loan, right, if you're using internal valuations, then what's the incentive to mark the valuation down and show a higher LVR? So those are the two real conflicts there.
Yep. And at the other end, I guess external valuations, that's the polar opposite, of course.
Yeah, it is. So much more transparent. Typically, what you have is get an independent expert valuer. So someone this is their core space, expertise. It's a large valuation advisory firm. So it's really, they're completely independent. They don't have any interest in the borrower or the lender. And so their figure is completely independent. They don't care whether the loan goes ahead and the valuation has to hit a certain figure. So they, very transparent, independent, and very detailed risk assessment of the asset.
Yeah, advisors might not so understand, I guess, the detail of an external val, is that they are 100 pages long. Valuations have a standard to follow, an industry standard. They've got ethical standards. They've got ESG standards they need to follow. They've got PI insurances in external valuation firms. The valuers themselves in these firms have got to get through their own internal panels when releasing vals. So there's a lot of governance, I guess, in an external val, isn't it? So, and I think the point is they might not be right still. So I think we should never pretend that a val is 100% always right. But when it's external, I guess the percentage of it being right is higher than not.
Yeah, correct. And I think probably 90% of the work in kind of getting a valuation done correctly is in having that independent external view. Someone who is got local expertise, local people on the ground, knows the asset class inside and out. And as you said, these reports are quite extensive, and they take weeks to deliver. So and they go for a very comprehensive approval process internally as well. So they're very detailed, and as a lender, you can really get to assess the risks of the asset from that valuation report quite well.
Yep. And the third type matter, hybrid, sort of a bit in between of both?
Yeah, so hybrid again kind of pulls a little bit from the internal part where sometimes a lender may still have a valuation, but they may have selectively chosen a figure or maybe even instructed a valuer to value it on a different basis, on a different assumption. And so that, again, is subjective and it's not fully transparent, and again creates the potential conflicts of interest.
So I guess if you look at all three of those, and these aren't loaded, questions, but the most reliable valuation type is an fully external val. The fund can't overwrite the val. Is that the fund must use the V determined by the valuer, so that the advisors can look at the V in those funds and know that it's independent, and the investment managers had no manipulation of it. And I guess at the other end, where the manager is got control of the V, and I think to your point, they're probably highly incentivized to at times manipulate the V if the underlying value is reducing.
Correct. So I think it's very important that advisors understand the methodologies that are out there, and I think really that independent is a big key factor. And again, drilling into you can go further into who is the valuer, were they a tier one valuer, because again, there's tier ones and then there's tier two. So, there is a separation between the two groups around just expertise and capability and local market knowledge and asset class knowledge. So that's quite critical again in getting the valuer right as well for the right asset.
Yeah, and absolutely. And you do see some funds that are, instead of getting a Chatterkett Kramer or a JLL value at an office building, say in Brisbane, 100 mil, they get Barry from Brighton valuing the asset and say, well, Barry's a valuer, so it's okay. It's like, well, hang on, that's not at all transparent, is that, the quality of the valuer themselves. And like anything, I think it's... is that as lenders, what we want is the most reliable value to determine risk. If you're manipulating your own valuation, then you're hiding risk. So, I guess once advisors might understand how the fund's valuing the V, which is the important part of it, the next bit is what's the asset. Is that the LVR is based on an asset, and there's physical assets and there's non-physical assets. Just be worth running through sort of how they work.
Yeah, so I guess in private credit, you've got asset-backed. So asset-backed typically is commercial real estate. So for commercial real estate valuations, typically it's, your security comprises an apartment building or an office or retail or industrial warehouses. So, if you have a tier one valuer in that space, the data's pretty good. Those firms are pretty good. You're getting a pretty good representation of what that asset is worth, and it's a tangible asset. And there's a lot of comparable sales data. If you were to value apartments in Fitzroy or Malvern, then there's a lot of recent comparable sales in those markets, and the valuation will usually be pretty spot on. Again, if you stick to the tier one valuers, for example. So that's asset backed. I guess as well, when you look at other, in private credit, there's other loan types such as corporate loans. You've got a different sort of call it a valuation methodology there. So it may be based upon an EBITDA multiple or a earnings profile or a future earnings trajectory of the business. So it can be a different, just a different profile of valuation. And so it's just a different. That's what advisors need to know is it's different between an asset backed and a corporate loan methodology.
Yeah, and listen, it's not good or bad, is it? Just that asset-backed valuations, and think of it, I guess, for advisors, think of it like your house, is that comping your house value is pretty easy for a valuer. They know the suburb, they know the square meterage, yada, yada, yada. So, yeah, when you're valuing a balance sheet, it's obviously a different beast, and it can be a bit of fugazi, and you've got professional valuers valuing assets, and then you've got professional accountants valuing balance sheets. They're just different. And I think also just for risk assessment of that is that the liquidity of both is very different too. In real estate, typically, we can get in and out of selling assets in sort of 12 weeks if we had to step in. But selling balance sheets is very, very different, and you typically can't liquidate a balance sheet quickly, can you?
Yeah, they're different. They're just different risk profiles and different assets, and selling down, 20 apartments in a Melbourne, in like a location like Fitzroy or Malvern, they're quite liquid, and you're not going to traditionally see a discount to valuation in selling those apartments. So it's a tangible asset, and it can be and the debt can be repaid progressively as well. So it kind of is a bit of a different liquidity profile if you think of it that way.
So fair to say, Matt, all valuations are not created equal in your world?
Yeah, correct. Absolutely. I think, within commercial real estate, you can, like I said before, you can really break it down between the tier one and the tier two valuers. And then again, you can break it down within the different methodologies. So, different valuers will have, again, different perspectives on different asset classes. And some of that will be driven by their internal house view. And it depends on the asset as well. So if you've got, pre-development land, then that asset class typically swings wider than completed apartments. So, that's just something to be conscious of as well.
So, advisors looking at private credit funds and doing a DD on private credit funds, from your side of the fence, what do you think they should ask? What's the questions that in your head will flush out, I guess, the black and white for advisors to see how the underlying funds are valuing their assets?
Yeah, so it really comes down to one of those three methodologies, right? So getting answers on those, getting answers on who the valuers are, and I guess it may be hard for advisors to understand who is a tier one and who a tier two valuer, but generally you can find it through their websites that you can see who's a tier one, and then how often when was the last valuation done, and how often are valuations being done across the portfolio. So, for example, a loan may have been extended once or twice without a valuation refresh, and all of a sudden that valuation is incredibly out of date, and that LVR may be incorrect. So yeah, it really comes down to the quality of the valuations, and then how is the lender assessing that valuation, and what number are they using?
Yeah, and listen, you raised another good point there, just in terms of the date of valuations. Yeah, is that an unscrupulous fund could use, say they've got an external valuation, but it's 5 years old. So clearly pointless in assessing the val. So the black and white of this is for advisors. Just do you have a val? Who did the val? What date is the val? And to your point again, if you extend the loan for purposes during the loan term, did you get another val, or are you just rolling a problem without getting another val? So the LVR is kind of fake. Listen, I think probably message for advisors really is that don't be fooled by the LVR headline of funds. I think you can't just in private credit just look at 60% LVR and say, well, that's low risk, and say 70% is high risk. That's not really the measure for advisors. You do need to dig deeper, and I think understand the valuation method, internal, external, understand the quality of the valuer, understand the fine print of the valuations themselves. How old are they? Have they been redone recently? And then, just obviously make sure that the manager gives the val. I think advisors rarely probably ask for a valuation, and I think advisors may be surprised just how much detail is in a 100-page valuation. And I think for advisors, I would say, Matt, if someone like you in a credit fund can't explain the val, I think for advisors, beware. Is that fair? Is it?
Yeah, I think if they can't explain the methodology and why they're using a certain methodology, or why they've accepted this valuation, or why they think that's a reasonable LVR against that asset, then I think, and if they don't want to give you the details, then I think that's maybe a red flag. I think it's pretty standard industry now to use independent valuations, and understanding who the valuers are and how they valued the asset. So there's a lot that can be understood by advisors when they go through and see the values used and the valuers and the dates of the valuation as well. And when you look at that by sector as well, every sector moves in different directions. So office at the moment is harder than other sectors like residential and industrial. So that office valuation may be under more pressure than an industrial or residential valuation.
Yeah. And I guess just to be consistent on this podcast, I will have my regular drive-by at the regulator is that, for advisors, again, just, ASIC, Rep 820 is giving some loose guidance to credit funds to disclose, but it's still very loose, is that, ASIC's not denoting the fine print of all this must be stated in credit funds. Is it just PDS's IMs are very grey on some funds around all these methodologies. So advisors can't rely on the black and white and the print. They've got to ask this. So I think if ASIC would just come out and say that, for example, all credit funds must have an independent val, I think that would take the industry to a new level, wouldn't it? But at the moment, advisors are stuck in this limbo between managers being able to manipulate vals, create them themselves, or external. How are they supposed to know? And unfortunately, the answer is always you've got to ask the manager.
Yeah, and that's where the manager trust really comes into the space as well, right? You're really trusting the manager to assess the risk properly and make sure they price the risk properly as well. And again, like you said, guidance from ASIC around purely independent valuations, and that you can't have a internal sort of tweak to the val or tweak a valuer assumption. I think that would be well placed.
Trust the manager.
Trust the manager, I guess. You've got advisors are getting better at this. They understand that they need to do more work on private assets and private valuations and your loans and covenants and such. So again, that's something that will continue to progress.
So hopefully we haven't sent advisors to sleep by now, Matt. I guess deep diving on LVR, but the V, I guess the message for us really is check the V, understand the V, know the V, and then I think that's, it's LVRs are key metrics of risk for advisors, so use it as such. It's not a return measure. It's a headline of risk for a private credit fund, know the V. So, So thanks, Matt. Appreciate the deep dive. As always with podcasts, the intent here is pretty simple, is that we're not talking product. We're trying to keep these conversations general and non structured to Woodbridge. So if you'd like to know any more information, please refer to the website or the show notes in the podcast.